I hope to no investor's surprise by this point in time that the market is just in a total state of flux as we enter into earnings season, which tends to excite investors, yet we must remain in a position of worry given interest rates are continuing to rise and will create a troublesome market landscape in the near term. But it's also important for you to recognize that I said near term, because what impacts us now today will soon enough be long forgotten about over the course of the next 3 to 5 to 10 years out. So what really remains important then is investing into high quality companies now to enjoy for years to come. Therefore, today I have 3 dividend stocks that are a solid buy to score before the end of 2023, which will deliver you with both share price appreciation and plenty of dividend income well into the future. With that, let's dive right in. So first and foremost, be a buyer. Always be a buyer, because timing the market in any sense has always proven to fail investors, even the best of the best. Therefore, it comes down to dollar cost averaging, and when incredible opportunities present themselves, then really go ahead and double down on them. However, with the market as is right now today, I must say there are some very attractive companies out there that I personally think you all should be considering right now before the end of 2023, which is likely only to be full of more uncertainty. Now, how am I defining quality when it comes to stocks that I'm talking about in today's video? Moreover, just investing into for the longer term? Simple. With 3 pieces of what I like to say are Buffett-proof criteria. With the first piece of criteria being the necessity for the company to have a strong brand name or reputation amongst consumers so their loyalty factor is built in. Next, a quality business must have an exceptional leadership team that conducts business to the highest of highest standards, not only for shareholders, but for their consumers, to ensure high rates of consumption and retention. And last but not least, a very clean balance sheet, so little to no debt. To which today I have 3 such dividend stocks for you, with the very first being an ultra safe bet within the beverage space. We have Coca-Cola, ticker symbol KO, which you all know, so who am I kidding here? I really don't need an introduction on Coca-Cola. However, I do think that you need to understand, as of right now, when it comes to Coca-Cola, it has over 200 plus brands on a global scale and an iconic staple of a beverage that just about anywhere can be found with food, so Coca-Cola will grant you plenty of security through the ups and the downs of the market. So when it comes to right now, when it's sliding to a share price of just $53 per share, which is down by nearly 12% on the year, it is time to buy, especially as this PE ratio consistently hovers around 24 or 25, is now at just 21.9. Now, here's the thing when it comes to Coca-Cola that you must understand if you're going to invest into it. It will hardly ever really be discounted. But from time to time, it does come down to a fairer share price for this reliable dividend king. And while some will argue that investing into Coca-Cola now is a waste because it doesn't grow that much, I say look at its history, where we see over 34% worth of share price appreciation. Sure, it's not at the highs of some other stocks, but it's reliable as can be. And likewise with its balance sheet, maintaining about $3.7 billion plus in assets with only $2.5 billion in liabilities, and consistently keeping up to par with its debt to asset ratio. That all keeps analysts optimistic about Coca-Cola, with a share price of $66.23 per share forecasted. It's over 23% worth of upside. As for hedge funds, we continue to load up here at these prices with over 510,000 shares purchased just last quarter. But it gets very favorable for dividend investors out there when it comes to Coca-Cola. These dividend insights come in at over 60 years worth of growth at a 3.4% growth rate over the last 5 years and a current dividend yield at 3.44%. Next up, I want to divert your attention to what I think is the most dominant consumer goods company in the entire world after its founding back in 1837. It's Procter & Gamble, ticker symbol PG. It's become an indestructible company with dozens upon dozens of brands that we not only use every day, but cannot live without, varying from baby diapers to all of our soaps and detergents, grooming products, and a plethora more. And what I love most about Procter & Gamble is the fact that whether the economy is skyrocketing or tanking, Procter & Gamble remains a business that is in business. Therefore, whenever their share price slides to a fairer value, as it is right now, or comes close to a more discounted share price, I am all over Procter & Gamble. Right now, it's trading for $145 per share, which is a nominal difference from where it was at the onset of the year. However, it still has this PE ratio hovering at 24.5, but again, think like Buffett here, and that it's just better to invest into a great company at a fair price than a fair company at a great price, because the returns here speak for themselves with over 88% worth of growth over the last 5 years. And of course, It's a company that's ensuring a balance sheet is shored up regardless of the market, with over 120 billion in assets, just 73 billion in liabilities, with a track record of great debt to asset ratio here. Now, as for analysts, we do see just over 12% worth of upside expected, with the share price bouncing back up to $164 per share, all while hedge funds pour millions into Procter & Gamble, with over 4.1 million shares purchased last quarter. But now, here's where it gets interesting for us dividend investors. We have a company with over 66 years worth of dividend growth history at a 5.68% growth rate and a current dividend yield at 2.58%. And as for our third and final stock, let's talk about Lowe's, ticker symbol LOW, which has over the past few years, really since COVID, has changed their business model to become this everything home improvement retailer, and it's made quite a difference in a business not to be reckoned with. As we can see, over 117% worth of growth over the last 5 years alone. Yet right now, down over the last 6 months, trading for just $198 per share after trading for $235 not too long ago at a PE ratio now of 19.3. Now, what I want you to understand about Lowe's, or even these other home improvement retailers like Home Depot or a play like Stanley Black & Decker, is the fact that their stock share prices are all reflective of the housing market. So of course right now they're down. Matter of fact, even DIY projects have been reportedly down, which all makes sense if there's financial uncertainty. Who's spending money on their home right now? Little to nobody out there. And you're probably saving money gearing up for what's to come. But all that aside, it leaves us with an opportunity here as analysts foresee over 25% worth of upside at a share price rising to $248.68 per share. Until then, it's all about the dividend income with Lowe's for the longer term dividend investors, considering their 59-year track record at a whopping 19.97% 5-year growth rate, with a dividend yield currently sitting at 2.22%. Now comment down below if you own any of these stocks or if you're going to be buying them soon. But moreover, if you found this video to be insightful, click over to this one. You'll find even more value. And of course, subscribe to never miss a single video.